Welcome to vTalkInsight, Market Drivers Daily for December 16th, 2025, where AI, repricing, shifting market leadership, and a surprisingly upbeat growth backdrop are all converging. Today we will look at how a more demanding AI cycle, powerful rotation beneath the surface, and signs of renewed global momentum are shaping risks and opportunities across markets. The AI theme still looks like a multi-year growth engine, but the tone has clearly shifted from blind enthusiasm to a tougher, prove-it phase. Demand and capital spending remain intense, yet investors are asking harder questions about how this build-out is funded and when it will translate into cash flows. Chip spending by the major cloud and data center operators is expected to stay robust over the next 12 months, helped by competitive pressure that makes pausing investment risky. Merchant silicon players such as NVIDIA and AMD are projected to capture roughly 3/4 of the AI chip market, supported by broad compatibility and strong software ecosystems, while supply remains constrained more by manufacturing and assembly bottlenecks than end demand. Corporate actions underline how strategic AI has become. Intel is reported to be in advanced talks to buy AI chip specialist Sambanova for around $1,600 million, at a markedly lower valuation than in 2021, and the market has welcomed the move as a way to strengthen Intel's position against NVIDIA. Broadcom has signaled the potential to double its AI-related revenue next year and possibly do so again the year after, while a successful listing of a major AI company is seen as a possible catalyst to unlock more public market capital for the sector, echoed by rising activity in IPO-focused exchange-traded products. At the same time, emerging markets such as India, Brazil, and Kenya are investing directly in AI infrastructure and strategies, aiming to build economic resilience and reduce reliance on developed market technology ecosystems. Beneath that growth story sits a growing gap between spending and monetization. Many companies report high operating costs and limited direct revenue from AI customers, and there is a notable disconnect between investors and management teams on timing. A large majority of chief executives plan to increase AI budgets by 2026, yet most do not expect meaningful profitability from these projects within 6 months, which challenges market assumptions about quick margin uplift. Earnings expectations for the big AI and tech leaders are now at their weakest in 4 years, narrowing the gap with the broader S&P 500, and current valuations for AI-exposed stocks increasingly depend on adoption and margin gains spreading beyond a handful of mega caps into smaller companies and non-tech sectors. On the risk side, concerns are mounting around leverage, froth, and policy. Heavy AI capital expenditure is leading some tech firms to take on more debt, raising questions about balance sheet strength and the capacity of credit markets to absorb continued issuance, especially if growth were to disappoint. In private markets, headline valuations such as an $800 billion price tag for SpaceX highlight how far some AI-adjacent assets have run compared with public peers, complicating IPO exits because listed investors are reluctant to accept those private marks. Legal and regulatory frictions are also building, with content owners like Disney striking deals to be compensated for the use of their intellectual property in AI models, and legal settlements, such as Anthropic's payout, to authors signaling that rights holders expect to be paid, all of which could raise the cost base for AI developers. Alongside that, U.S. authorities are pushing for a single federal framework to replace the current patchwork of state-level AI rules. While research shows advanced chatbots can be highly persuasive in a political context, increasing worries about misinformation and future regulatory intervention. Despite these challenges, AI is still framed as a multi-trillion-dollar opportunity in the U.S. alone, with the potential to lift productivity for more than 130 million workers and to broaden from today's infrastructure build into end-user sectors such as financials, healthcare, and utilities over the next couple of years. Importantly, current U.S. corporate spending on AI and technology research is large but not unprecedented when compared with past infrastructure booms, which argues against simple bubble analogies even as valuations in parts of the space look stretched. The key watch points now are earnings revisions for AI leaders and laggards, capital expenditure guidance from the major cloud and semiconductor players, credit spreads for highly levered tech issuers, and the next wave of legal and regulatory decisions around data, content, and model use. How those factors resolve will heavily influence whether the recent AI-led volatility remains a healthy reset or evolves into a more durable rotation in other parts of the equity market, which brings us directly to the widening divergences across assets. Market leadership is no longer the story of a single handful of mega-cap tech names. It is slowly but clearly broadening. Recent weeks have seen investors rotate out of some high-flying AI beneficiaries and into financials, industrials, healthcare, defensive consumer names, and smaller companies, as they look for earnings that feel more achievable and valuations that carry less downside if growth stumbles. The equal weight S&P index has reached a 52-week high and sits only about 4% below its November peak, suggesting gains are now being shared more widely across the index rather than concentrated in a few large technology stocks. Regional performance gaps are striking. Non-U.S. equity markets have significantly outpaced U.S. stocks this year, reportedly posting the widest outperformance since 2009, helped by episodes of dollar weakness and improving earnings revisions across both developed and emerging markets outside the U.S. Emerging market equities and debt, in particular, are expected to benefit when the dollar softens because cheaper dollar funding improves their balance sheets and fundamentals, providing a relative boost versus developed markets. Yet the U.S. still dominates global corporate rankings thanks in part to far higher research and development spending, with some American companies investing more individually than entire European countries, which underpins the view among many that U.S. equities remain a structural core despite the recent relative underperformance. At the sector level, rotation is just as pronounced. In equities, defensive consumer staples such as Coca-Cola have delivered mid-teens price gains this year, while still offering dividend yields close to 3%, even as higher growth names like ARM have lagged, challenging the idea of an indiscriminate tech bubble and highlighting renewed interest in resilience. Healthcare valuations are described as historically low after underperforming the S&P 500 by more than 50% over 3 years, which means even modestly positive news could have an outsized impact on returns in that sector. Industrials have broken out of a 5-month trading range, supported by expectations for economic stimulus and favorable depreciation policies, while information technology has recently underperformed as losses in names like Broadcom weighed on indices. Financial stocks, as tracked by the KBW Banks Index, have beaten tech since early December, and there is growing focus on value, small cap, and mid-cap exposure as a way to diversify away from the narrow U.S. large-cap leadership of recent years. Divergence is also visible in who is buying and how assets are priced. Retail investors have been aggressively adding risk on pullbacks, with margin loan balances reported up around 40% over 6 months, whereas many institutions remain more cautious and underweight, preferring to wait for clearer signals on earnings durability. In the real economy, the U.S. continues to show a K-shaped pattern. Affluent households are still spending strongly and supporting sectors like live entertainment, while lower-income groups report very weak sentiment, raising questions about how sustainable broad-based consumption really is. China shows its own split picture, with fresh policy support boosting domestic retail names, even as iron ore prices fall toward $100 a ton, weighing on China expose European equities and underlining how different parts of the China complex can move in opposite directions. Private and public markets are also out of sync, with examples such as SpaceX reportedly valued around $800 billion in private transactions and IPO activity constrained because public investors are reluctant to validate such elevated private marks. For portfolios, these divergences mean index-level moves tell only part of the story. Dispersion within and across markets is doing more of the work. Broadening leadership can reduce concentration risk and give more sectors a chance to participate in any further upside, but there is an important caveat from earnings. Several views stress that any lasting rotation away from mega-cap tech requires sustained profit improvement in the rest of the market. Without that, shifts into financials, healthcare, industrials, or non-U.S. equities could prove short-lived if investors rush back into familiar winners at the first sign of macro stress. On the other hand, U.S. equities are still seen by many as having stronger innovation and earnings prospects than most peers, which may anchor a continued, if smaller, tilt toward the U.S. even as international diversification becomes more rewarding. Key gauges to watch are earnings revisions for small and mid-caps, sector relative performance versus expected growth, the dollar path for emerging markets, and signs of strain from elevated margin borrowing, all of which will interact closely with the evolving growth backdrop. The macro narrative underpinning all of this looks increasingly skewed toward resilience and even reacceleration rather than imminent slowdown. New York Fed President John Williams now anticipates U.S. growth of roughly 2.25% next year, up from about 1.5% this year, reflecting an upgrade in perceived economic resilience despite recent uncertainty. That assessment is broadly consistent with wider central bank commentary pointing to improved and more balanced growth into 2025, backed by earlier rate cuts, ongoing fiscal stimulus, and strong capital spending, particularly around AI and infrastructure. Strategists are notably upbeat for 2026, with no major houses reportedly forecasting a down year, a sharp change from the caution that followed the volatility of 2022. In the U.S., several concrete engines of growth are in play. An anticipated wave of around $50 billion in tax refunds in the first quarter could provide a temporary lift to consumer spending, and fiscal measures on both corporate and personal taxes are projected to accelerate growth into late 2026, with limited inflation impact if a softer labor market keeps wage pressures contained. The country is also experiencing a manufacturing renaissance concentrated in Sun Belt states such as Texas, Arizona, Tennessee, and Georgia, driving demand for industrial real estate and large-scale infrastructure projects. Dallas stands out, with major financial sector investment, including a roughly $750 million campus from Goldman Sachs and participation in a new Texas stock exchange, underscoring the shift of economic activity toward the region. Homebuilder sentiment has improved to its strongest level since April, and a projected 118% surge in data center investment by 2026 points to powerful ongoing support from AI-related capex, even though power availability may limit how quickly new projects come online. Company-level stories provide further evidence of this growth tilt. Barnes & Noble reports particularly strong sales in 2025, has opened 67 new stores this year, and plans to open 68 more across 2026 and 2027, guided by population growth in states like Texas and Florida. GE Vernova's long-term service agreements on gas turbines are expected to deliver recurring revenue and outsized earnings growth well into the 2030s, an unusually visible runway within industrials. In software, ServiceNow highlights more than 20% organic revenue growth for a decade and sees AI-driven employee experience features as a way to unlock new business models and revenue streams ahead of its upcoming stock split. Ford has raised its EBIT guidance for the year from around $6.5 to $7 billion thanks to better cost control, higher quality, and a pivot towards more profitable hybrids and affordable vehicles. Hybrid sales at Ford are growing quickly, with a 20% increase last month, and hybrid F-150 trucks representing up to 30% of sales, while the company repurposes battery plants to produce energy storage using LFP technology for utilities and AI data centers, targeting profitability as early as 2027. Outside the U.S., the picture is uneven but improving in key areas. European households remain cautious, as seen in elevated savings rates. Yet even a stabilization in consumer behavior could support a recovery, especially with purchasing manager indices already pointing to above-trend GDP growth for next year. Italy's recent improvement is linked to effective use of European Union fiscal funds, though the sustainability of that upswing will depend on private sector momentum as public spending fades. Emerging economies including India, Brazil, and Kenya are stepping up AI infrastructure investment to build resilience and reduce dependence on developed market technology, while emerging market assets more broadly are positioned to gain from any further dollar depreciation. China continues to matter greatly for the global cycle. Authorities have signaled more financial support for domestic consumption and are likely to pursue additional monetary easing to hit a 5% growth target next year, even as domestic weaknesses and property sector stress persist. Chinese exports, including high-tech goods, remain robust, and local equities have held up despite soft data. But falling iron ore prices near $100 a ton have weighed on China's sensitive European miners, showing how stimulus benefits are not evenly distributed. Set against this constructive backdrop are important risks. Consumer sentiment in several economies is still near historic lows, and the K-shaped pattern in the U.S., where high-income households spend freely while lower-income groups struggle, raises doubts about how inclusive any growth acceleration will be. For the AI theme, broader economic momentum is now a key support. Doubts are emerging over whether current infrastructure, spending, and earnings growth can persist without stronger macro data, especially after disruptions such as the recent U.S. government shutdown clouded the statistics investors rely on. Further out, fiscal stimulus expected in the second half of the decade could intersect with tighter supply constraints or renewed labor strength, potentially reigniting inflation pressures and complicating central bank policy. Upcoming manufacturing and services PMIs, the pace of Chinese easing, realized consumer spending from tax refunds, and the follow-through on data center and manufacturing projects will be critical markers for whether this late-cycle upswing can extend or whether growth in markets reconverge in a more volatile way. To sum up, the AI cycle is moving into a more disciplined, prove-it phase with strong demand but sharper scrutiny on leverage, monetization, and regulation. Market leadership is broadening beyond U.S. megacap tech into financials, healthcare, industrials, and non-U.S. markets, creating rich dispersion but also requiring closer attention to earnings quality and regional dynamics. And the growth backdrop, while clearly late cycle, is tilting toward reacceleration into the middle of the decade, powered by fiscal support, AI and manufacturing capex, and selective consumer and corporate strength, even as K-shaped demand and policy risks temper the optimism. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.